All right, Krishnakumar joins us now with Sundaram Mutual Fund. Krishnakumar, normally I've asked you tough questions on why markets are going higher, why markets are going higher despite weak earnings and economic conditions. So let's, for a change, ignore fundamentals and talk about liquidity. Because everybody we are getting on the channel is admitting that economy is bad and it is only liquidity which is taking markets higher. So my question to you is that if liquidity is abundant and there is going to be low interest rates for a long time, what is the end game now? Because if the conditions which are driving the markets higher are going to be intact for next 6 to 12 months or 12 to 18 months, then can one safely assume that the party will continue and markets will have complete disregard for valuations?
I think you asked the same question in a different way, but so the markets right now are driven by a lot of liquidity coming through from the US, particularly. While the most important things to observe at this point is the improving data that is coming through as we open up. We have seen a good experience in China in most sectors. They're back to normal, near normal. US, Europe, a lot of other countries have seen a fair bit of improvement in terms of their operating metrics across different parameters, normalization of social life to some extent, a pullback in consumer confidence, etc. In India also, if you see the last 1 month, we've been doing a lot of checks with corporates and channels to see what's happening. The commentary definitely from the NBFCs and banks have been far better in terms of collections and disbursements moving ahead. So also in the case of automotive sector, dealerships are seeing walk-ins and a good amount of pent-up demand is coming through. So all in all, I think the experience globally and in India will be the same, that where supply normalizes, there will be demand that will come through. While, of course, you're not going to hit the same levels of pre-COVID immediately. It will be a 6 months to 12-month journey. As month on month, we improve in terms of numbers. And so the markets actually are not just driven by liquidity. I would beg to differ. I would also like to believe that there is a lot of improvement on the ground that we are noticing. While everybody is cautious, watchful, but slowly and steadily, the improvement is getting factored in into the prices, be it the frontline banks or the NBFCs or the mid and small caps, as you were mentioning earlier. The stocks that are beaten down 80-90% are seeing some pullback of 15-20%. So there is some normalization that is happening, and I think that's the way we believe that the fundamentals will catch up with the market over the next 6 to 12 months and therein move on. The question in the longer term is how the liquidity gets unwound, etc. Definitely, as the global central banks see normalization in their economies, they would start to definitely tighten the liquidity, raise rates, etc. But I think from the commentary of the US Fed and central banks in Europe, clearly that's quite some time away, as you also mentioned. So right now, I think there'll be supportive liquidity conditions globally, and a bit of risk on trade that is happening, driven also by the opening up and the good news that is coming through.
Okay. So my question is that while markets have anticipated a strong recovery, and if recovery is strong, some would argue that when the actual recovery will happen, KK, let's say in second half of this year or first half of next year, then markets are unlikely to move forward, because if markets have already moved in anticipation of earnings recovery, so then when the actual recovery will happen, will markets come down?
See, the initial reaction that we saw in February, March of sheer panic pushed valuations also, to levels much below fundamentals, intrinsic values. So there has been a bit of catch up on that, as the fear gave way to some caution. I think markets and valuations have normalized, And then there is this leg up that we are seeing now, which is discounting a bit of the improvement that we are seeing and the strength of the improvement of the future. While I do agree that at these levels, in the the way the markets are, the market valuations are quite reasonable. I would find it difficult to justify a strong rally from here in the near term. Of course, that will keep moving up slowly. So there could be a bit of a correction in terms of time correction as we wait for more news flow to strengthen our case for the recovery. Of course, specifically, there could be a lot of value in different sectors and stocks, and hence, typically in this kind of a market move after the sharp corrections because of events, we find that value comes back, and value investing play up, and after some time, then that moves on into getting seen into a growth coming back and growth stocks coming to outperform. So the path of recovery we see is initial value coming back into the markets, and then growth taking over after 6 to 12 months.
Okay. KK, good morning. I wanted to talk about parts of the market that are looking exciting. And, Sundaram has a large dedicated rural fund as well. We've been hearing a lot about a pickup of activity on the rural side from corporates. And, of course, we all know that the government has also directed a lot of funds there. So how are you, working that theme in terms of pockets that you feel could benefit, and how excited are you about the opportunity there?
Yeah, definitely. I think in this current state of affairs, the good news is that the last 1 year has been good for agriculture, and broadly rural incomes have been holding up, and more efforts by the government to assuage the worries of the poor, and the rural is helping. And the good news is that this year the monsoons are good, and the sowing area is going up. So what we do understand from the agri markets and rural areas are that things are a lot better than what was there a year back. So this really will be a very supportive factor for consumption broadly, because there is a lot of base level consumption that comes through from the rural side, in addition to that aspirational consumption that we always talk about, as more and more of India becomes more aspirational and conscious of the of upscaling into the brands, etc. So that's a positive from a medium term perspective on consumption, particularly the higher end FMCG products, and also the low ticket consumer discretionary appliances, etc., and the two-wheeler and the tractor space that we would play. More importantly, on the agrochemical side and seeds, I think that industry has been doing well last 6 months, and we do believe that in the next 12 months there is going to be a continued demand uptick and pricing benefits that will come through for that space. Also, these companies in agrochemicals and specialty chemicals have another leg in terms of global supply chains, and we have seen most of them being able to secure large contracts for supplies overseas. And so that's a sector that we continue to remain optimistic about in the medium term.
Great. What about telecom as well? I mean, I know there are only a couple of picks there, but I want to get your view on all the recent news that's taken place when it comes to the sector, from continuing tussle around AGR to very bullish commentary on the growth prospects, post this period for the telecom sector. How are you viewing the most recent developments?
Clearly, in the last 1 year, consolidation across the industry with a lot of weaker players going out has been helpful, and in a way that's also made the government kind of become more pro-industry, trying to help the industry to stay afloat and help the bank system to get back their dues from the sector. So in that way, I think that's the biggest change that we have seen in terms of the government coming in to support the industry. Along with that, I think more than just the pricing expectations on the telecom space and the value creation there. The larger part of the play has been how these telecom companies could turn themselves into more internet plays and a framework plays like the Alibaba, etc. So if you look at one of our leading companies, we have seen a lot of investments from global majors coming in, and they're not coming in for just telecom. So they are coming in for a more the benefits of being invested in a platform player from where they can leverage the social connect, the payments enterprise, the e-commerce across the different categories like groceries, other retail, apparel, and footwear and other things. So I think it opens up a whole host of enterprise that you could do through these telecom companies if you transform yourself, which Jio has proved. So I guess that's the biggest long-term story that's played out in the markets in the last 3 months.
KK, hi, morning. Just Nikunj and I were chatting about it as to how Reliance has single-handedly done all the heavy lifting for the market recovery. Where do you see leadership emerge? And do you think the weight can now shift to some other segments, some other stocks, which could actually lead the market higher from here if indeed it has to move up further? Because yes, there is dominance within pharmaceuticals, but unfortunately, the weightage on the index is not as high.
Yeah. So always we try and scout for leadership changes during these inflection points. So at this point in time, the way we see it, that's been playing out time and again, and this time also, is more from leadership moving to value across mid, small, and large caps, and then morphing back into growth investing. I think that's how I would look at it from a style perspective. In the next 6 months, you see more value continuing to play up, and then you get back growth, and people move on to more secular growth stories. Having said that, from a sectoral perspective, leadership change, etc., I would believe that consumer, discretionary is something that cannot be, ruled out. I think they would definitely kind of come back because that's a long-term story in India. So I would believe that consumer discretionary across durables and auto will definitely continue to be a mainstream investing place for us. And it's very difficult to imagine that India will do well without banks. So I think banks will also make a comeback. So from a medium-term perspective, I don't see a leadership change. I see them come back into driving the markets in the next 6 months.
On the subject of KK, whether it is going to be the broader market which is going to recover faster from here. We've all seen the underperformance of mid and small caps, which has now lasted over a year now, or even well above that. While we're fixated on the Nifty levels, in the month of June itself, there's been a bigger recovery that one has seen in both the mid as well as the small caps, and they've managed to outperform the benchmark indexes. Do you think tactically one needs to perhaps go a little bit more overweight on the broader end of the market, or do you still think the times are tentative and one is safer investing in large caps?
I think definitely, the value curve is a lot more available in the broader market. So in spite of some of the up moves we have seen, I would believe that there is a lot of value around the cyclical sectors, and a lot of them are in the mid and small cap space too. So I think I would, look to broaden the investment into more of mid caps and small caps into the portfolio. I think if you take a 1 year plus view, you will definitely be rewarded, is my opinion. I'm not saying that we should go all out into mid and small cap, but I think that 65-70% large cap and 30% mid and small cap should move more to 50-50 in the near term. whether in the next 1 month, 2 months, we could use the time correction to make the portfolio changes. But I think definitely there is a broad-based recovery and a broad-based rally that will come through in the markets over the next 1 to 2 years.
Okay. KK, thank you. Good to have you with us, particularly sounding positive and looking at a lot of those segments fairly optimistically. Do have a good day going ahead.